So good afternoon if you're in continental Europe or the UK, and good morning if you're on the East Coast of North America somewhere. My name is Hamish Stewart. I'm the Sustainable Finance Practice Lead here at EcoAct, and I'm thrilled to welcome you all to this post-COP27 update webinar. There's been a flurry of activity over the last couple of weeks at the COP27, and then there's a lot of work that's underway with asset owners and asset managers and other financial institutions around the world from COP26. So the point of this webinar today is just to bring together some leading institutions, some leading asset owners who are really in the midst of this net zero journey, and to learn what they think was substantial at COP27, and actually what they're working on already and what they plan to carry on in this year ahead. And I'm going to go through a bit of housekeeping, and then we're going to have a Q&A, and then we're going to open it up for some audience Q&A. We're lucky to have an audience. We had around 500 participants sign up for this, so a mix of investors, banks, and companies, and it's really great to see the level of interest in this sort of net zero transition process and how finance actors are participating in this system alignment with the climate goals. This is just a bit of Q&A, but a bit of housekeeping to start with. You can see the agenda here. The webinar is recorded, so if you want to share it with any colleagues following this session, you're welcome to. I'm going to just introduce the presenters in a moment, and then we're going to have some questions, and then my colleague Catherine Chisholm is going to run the Q&A. If you have any questions, you can see there's a Q&A function. It should be in the bottom of your screen. You can put the questions in there, and then Catherine will review those, and we'll get to them in the discussion section. And what we're going to do now, just to start off with, to see where everyone's at, we're going to launch a quick poll. So if you can launch the poll, please. We just want to see where everyone's at. Maybe we'll, we're getting some answers in. So the question here is, have you set a net zero target? And just see how much uptake there is of the poll function here. Okay. That's good. While we're polling, I'm just going to move ahead here to introduce our speakers. So we're really, like I said at the beginning, we're really lucky to have a couple large asset owners here to kind of share their experience. They all have net zero targets. The first speaker is Hilkka. Komulainen. She's the head of responsible investment at Aegon UK here in London, and she joined Aegon UK in 2021 to lead the newly established responsible investment team there and to really drive forward Aegon's responsible investment proposition. This includes progressing in the integration of ESG factors into the investment decision-making process across a number of Aegon funds. Prior to joining Aegon, Hilkka worked with the Principles for Responsible Investment, EY, the OECD, the United Nations, and a number of other investment firms. And she's also, I know Hilkka from our work at the Net Zero Asset Owners Alliance, where Aegon is a member. So, a real expert in this space, and I'm looking forward to hearing, what she's taking away from COP27 and also what they're working on at Aegon UK. The next speaker is Jamie Stader. She's the Director of Climate Infrastructure at the New York City Comptroller's Office. The New York City Comptroller's Office is the fiduciary for a pension system there of 5 pensions that are managing around $242 billion US in assets. And they have a number of those pension funds within that system have their net zero target they're working on. And there's a climate action plan there. And also, I'm really looking forward to hearing from Jamie about the interaction of investment practices and net zero goals with the public policy side, because the Comptroller's Office has a link with the City of New York in a unique way. But it's important for how they calibrate their climate goals and the implementation timeline there. And then finally, Adrian Chapman is head of Group Climate and Liquidity ALM at Legal & General here in London. He's providing particular guidance on climate-related ALM and investment issues across Legal & General Group. So this is a large diversified insurance and financial services company. So there's a lot of moving parts there. He's also LNG's representative on the Net Zero Asset Owner Alliance, and he's leading LNG's development of investment-related science-based targets with the Science Based Target Initiative. I think we're, we've got a lot to unpack here today, and there's we got 3 experts with that. So I'm going to end, if we can end the poll, and we'll come back to these questions in the Q&A. I'll just end the poll here, and just to so we can see where people are at, I'm going to share the results so everyone should be able to see those. So this is, we can see sort of where we're at, and then can everyone see the responses? And then Catherine can have a closer look at them, and we can discuss them on the back end. So here we are, the speakers who were introduced, and then this is a bit about EcoAct, which I'm not going to dwell on. So from my personal takeaways from COP27, I mean, it's still all about the money. The financing for climate adaptation, energy transition is just not forthcoming from governments yet. And I think what we've seen in the last year is this real increased scrutiny on the finance actors' net zero and climate commitments, and how the money is flowing. And that's, part of the genesis of this webinar, is to find out what the leaders are doing and what they're thinking about, because everyone who made a commitment to COP26 has been under some pressure to explain and substantiate their approach to net zero. And I think we have some of the leaders here in terms of thinking through the methodologies, and then the sequencing of an asset class based transition to net zero. Also, the COP was the UN Secretary General's task force report on, sort of broadly speaking, on greenwashing risk and the need for greater fidelity in climate targets. And also, something that I've noticed is a lot of the G20 regulators, led by some colleagues in the UK, are really kind of moving the enforcement ball along. So they're not able to do everything, but they're also interested in looking into some of the green financing claims. Of course, the COP27 is a public policy and government focused event, and so the big announcement that we all saw was this loss and damage fund for vulnerable countries being added to the agreement. Except the question is, how is that going to be capitalized? And I'm hoping today some of the speakers might want to comment on blended finance, and just the what kind of instruments are there so that private finance actors can support these government finance aims. Also, we see big policy shifts. So the EU is actually implementing its Green Deal and some of the Sustainable Finance Action Plan work there. And then the US's Inflation Reduction Act is a massive, effective fiscal policy stimulus for everything clean energy related. And it's yet to be seen how investors are sort of digesting that and maybe increasing allocations in infrastructure and other assets where they can get in on the very large fiscal stimulus in the US. And finally, in terms of shifting financial flows and adjusting access to global capital, especially in the debt market, the Prime Minister of Barbados, Mia Mottley, she's launched the Bridgetown Agenda, which is looking at enhancing emerging market and developing country access to special drawing rights at the IMF, and also restructuring some of their relationships with creditor countries in the Paris Club. So a lot to take in, but the nice thing about this webinar is we have institutions that are taking a macro view, but then trying to implement things in their own organization and engage with investee companies on these goals. So with no further ado, we are going to move into the discussion. I'm going to stop my screen share so we can have a slightly more collegial atmosphere, and I'm going to welcome Hilkka to make some opening remarks and just share a bit about what Aegon is up to.
Perfect. Thank you so much, Hamish, and good afternoon to everyone here as well. So my name is Hilkka Komulainen. I head up responsible investment at Aegon. We, like many organizations, made a net zero commitment a couple of years ago, recognizing that climate change is one of the largest risks that face us. And as a long-term savings provider, my role covers both the pension side of the business, as well as our retail platform, where we provide access to savings. Climate change is something that touches upon all of us, and we have both the opportunity and the duty to support ambitious climate action. We consider it as part of our fiduciary duty. We need to manage risks, achieve target returns, and if our kind of average customer in our workplace defaults, the fund that they stay in unless they personally make active decisions about their pension savings, which we know that 90% of customers don't do, then it is our responsibility to be managing that risk. If you are 41 today, then for the average customer, climate change and what happens by the time we get to net zero is extremely material. So we consider kind of the age and retirement pathway of our customers. Pensions are some of the most long-term business models in the world, which does make us as well positioned to be thinking about these topics. We also survey our customers on climate change. We know that 73% of our customers, it typically does fluctuate, but it tends to stay around 70%, who consider that climate change is a concern. It's an important risk to consider when investing, and people are concerned and worried and expect us to be taking action. What have we done then? How do we think about this? We, as Hamish mentioned, are members of the Net Zero Asset Owner Alliance, who have helpfully put together guidance for on target setting, like how do you actually implement your net zero strategy, which is part of the guidance that we are following. And this then touches upon everything from our engagement, our asset allocation, where we decide to invest or divest, as well as thinking about what are the actors that we invest with, and how does that kind of influence growth throughout the value chain. We're an indirect investor, as many asset owners are. We invest exclusively through third parties, asset managers, and as Aegon, we have quite a wide array of them. So we really kind of are exposed to vast number of players in the market. So for us, a really key part of this is actually integrating it into what we are expecting from our asset managers. So this is done through a number of ways. Our responsible investment policy outlines those expectations and in specifics. So things like supporting us on the same goals that we have set. We do expect asset managers to be working towards net zero, and particularly to be supporting us on our own net zero commitment. We ask them to be working with others when it comes to implementing climate risk management. As we've just seen at COP27, it takes a village, and even when there is a village, that's still not enough. So that point about helping raise standards across the industry, the way we think about it, we like many asset owners are very broadly invested in the market. There's no way we're going to divest our way out of this. There's no way we can exclude the companies that are most at risk. Therefore, we need to be influencing the breadth of the market and being able to work with many asset managers, and kind of increasing accountability for them really helps. It is interesting, having kind of observed this over the past couple of years at Aegon. There's a vast number of net zero commitments that have been made. I think the Net Zero Asset Owner Alliance this year found that 60% of members, so the asset owners themselves, had set net zero targets. But when we look at the asset managers, there's still work to be done in terms of transparency to clients. What is it that they are doing, and how's this translating into their activities? That comes from the kind of capacity that they are building to analyze and manage climate risk in their portfolio, the kind of engagement that they're having with the companies that they invest in directly. We're typically not the ones who are in dialogue with the large emitters. We're not showing up at Exxon's AGM or holding the vote. Typically that is the manager that does that on our behalf. But what we're asking for is more transparency. And how do you think about climate risk for this company, and how are you managing that? How are you thinking about sector-specific decarbonisation? Where do you think your portfolio needs to go? What are your hypotheses around that? Earlier this year, we concluded our oversight exercise around our responsible investment policy. So looking at where asset managers' practices are at. We do find that there's 80% of our managers that had at that point set a net zero commitment. I recognise there's probably been more movement in the industry over the past year, but at that time, only 42% of them had actually set which part of their assets that net zero commitment applied to. So kind of the high level thinking was there, but the practicalities of how this is going to work is still evolving. own less than 25%. We're actually linking that into their engagements. So talking to companies on specifically how you're going to get to a 1.5 degree pathway. And overall, that kind of limited ability to quantify transition risk and physical risk. I mean, nobody expects everybody to have all the data and have all the measurement. It's a tricky area, but progress in that direction is absolutely essential. And this last point is particularly relevant, where we know that 1.5 degrees after COP27 is at risk. We're not seeing the inevitable policy response coming through, at least not yet. I mean, there's always hope for next year, but next year is awfully far away today. But therefore, understanding what are the scenarios our managers consider, what are the long-term risk implications from the perspective of our average 41-year-old pension saver, what does it mean for them? How are you incorporating that into good decision making is absolutely essential. I think we're going to get into more of the conversation, but I'm going to pause there in terms of Aegon's own approach.
Thanks a lot. I mean, there's a fascinating question, and we'll get to it in the Q&A around the transmission of these targets through to the operating companies, and then the level of receptiveness on the part of the asset managers to help the asset owners meet their own targets. So now we'll just hear an introduction from Jamie Statter, at the Director of Climate Infrastructure at the New York City Comptroller's Office. And I'd like that this sequence, because like I said, Jamie sort of straddles the investment side with the pension fund, but also on the public policy and the climate adaptation side with an actual city that is, if anyone was around for Hurricane Sandy, it was pretty real. So, thank you, Jamie, for letting us know your perspective on this and the net zero as a large asset owner.
Thanks. Yeah, and I think it's helpful to hear Hilkka's introduction as well, because there's some critical similarities and differences from our side. As you noted, my boss, Comptroller Brad Lander, is a trustee on 5 public pension funds, the public pension funds of New York City. 3 out of those 5 funds their trustees voted to divest from fossil fuel reserve owners several years ago. We've completed that divestment. That makes these funds the largest divested funds in the US, public funds in the US. Since then, the trustees, and very much driven by the elected trustees of each of these 3 funds boards, voted to establish a net zero target. Our net zero target's a little different, which is challenging in and of itself, in that it is net zero by 2040 in these 3 funds. And in the time since, completing just about now, our team has been working to draft and get approval from our trustees on an implementation plan that is robust and can really guide us through the next several years to ensure that we're able to meet our targets. We are also primarily dependent on our asset managers. All of our assets are managed by third parties, and so asset managers are a critical piece for us. In Comptroller Lander's role, in addition to sitting as a fiduciary on these funds, he also serves as Chief Risk Officer for the city, is responsible for issuing municipal bonds alongside the OMB locally, and really looks at this issue holistically, both as a fiduciary duty to manage the risks associated with climate change, and then of course to manage the risks associated with New York City. So there is some interplay there, although these are discrete areas of responsibility for the comptroller. There are areas that we really need to think about how one affects the other and whatnot. And especially on the public finance side, the municipal bonds, we've recently, for example, been in conversations about our ESG rating for those bonds and what that looks like related to climate resiliency, adaptation, and risk in the future, and what we're doing as a city there. So there is a lot of things happening on the market that the comptroller is responsible for, and that interplay with the work of the funds. I will add that we, unlike Hilkka, we typically do vote our own proxies. We file resolutions, and we have a robust and growing corporate engagement strategy. I expect this to be a large portion of our team's work in the coming years, really thinking through how to manage this engagement once we have our board's approval on the net zero plan. It is kind of critical that we manage both high emitting sectors and sectors that are not the highest, but once we deal with high emitting might move up the ladder. And that's something that we're really focused on. But in general, our focus on the net zero plan is that we have measurable goals and benchmarks, specific reduction targets, and/or a plan to get to those targets that has interim steps. We are looking at scopes 1, 2, and 3, and we're evaluating this from a diversified implementation approach, including, as I noted, divestment, which is completed, and then all the way on the other end of the spectrum, a large commitment to investment in climate solutions across asset classes. And that would be 50 billion. The goal we set so far is 50 billion across the 3 systems that have a net zero plan, and then across asset classes. We have begun setting interim targets for scope 1 and 2 that are consistent with the science-based targets. Sorry, I have a barking dog there. We have, and in the recent past, we've done a lot of work to engage our asset managers on this. We wrote a letter to BlackRock, who is our largest asset manager, which some of you may have seen it. It was a public letter calling on them to be more transparent about their goals and implementation approach for what they say is a net zero plan. We asked for specific targets and timeframes, just like us. And Comptroller Lander really believes across the board in his responsibilities in showing your work. And that is basically what we're asking our asset managers to do in the coming years. Show your work around science-based targets and net zero implementation plan, and then be more transparent, which is something we also implement across our office in various roles and responsibilities. We are looking to see asset managers disclose climate-related lobbying, and lending and insurance for fossil fuel supply projects, and then support science-based targets within the portfolio companies. And obviously, this is something that we all, as asset owners, will need to work on together in the coming years. And we hope that our asset managers will be able to kind of grow alongside us and support us in these efforts, because we are very much dependent on their consistency, transparency, and approach to get this done. So I'll pause there. I'm sure we'll have more to talk about in a few minutes.
That's great. Thank you. I mean, I would really encourage everyone on here to read Comptroller Lander's letter to BlackRock. Just the level of specificity and the information it's asking for is kind of what I would expect all asset owners to want to see from their asset managers. So it's a nice, it sets a nice floor for information from an external asset manager. And the point around sort of engagement with public finance, and as being a municipal bond issuer, I gets to some of the, I know we're going to hear from Adrian now, but in Legal and General's climate policy, they look at public policy engagement as well. And so I think there is some kind of convergence around the view that public policy has to be aligned with net zero pathway in order for larger asset owners and everyone else to align their portfolios with the same goal. And so, I mean, it's really, thank you for all that detail. And now I'm just going to invite Adrian Chapman to share Legal and General's perspective, and he's been doing a lot of work on different continents on this, including with the Science-Based Targets Initiative. So thanks, Adrian.
Well, thank you, Hamish, for inviting me to speak on this panel today, and also great to share the stage with Hilkka and Jamie and hear their introductions just then. So, as introduced, my name is Adrian Chapman. I work at the group function at LNG, particularly overseeing our investment approach around climate. And climate change has been a growing conversation within LNG for several years. We reported our first TCFD report at the start of 2019. As part of the end 2018 financial disclosures, with 3 subsequent annual reports produced since. And from our first report, we stated our support of net zero by 2050 targets across our business, and we've been evolving these commitments ever since. So the way we look at this at LNG, being a diversified financial services organisation, we consider climate change issues and set targets across 3 pillars covering our group-wide activities. Firstly, in building on Hilkka's approach, as an asset owner, we invest around about 100 billion pounds worth of proprietary assets we hold on our balance sheet. Those are the investments to which our shareholders are exposed. And here we've set a suite of portfolio decarbonisation targets across multiple timeframes, with short-term targets for the end of this year and by 2025, leading up to our commitment to reduce the emission intensity of our proprietary asset portfolio by half by 2030 from a 2019 baseline. This portfolio covers traded credit and equity holdings, as well as a growing number of more direct and bespoke investments. Some of these are across the renewable energy spectrum, focusing on progressing and enabling the required scientific development and infrastructure within the renewable energy ecosystem. That's our first pillar, how we invest our own assets. The next pillar is through how we influence through the 1.3 trillion worth of AUM within our LGIM asset management business. So here we're slightly different. We have an asset owner business and an asset manager business. Here we bring together our engagement through our stewardship team as a large shareholder across the listed equity universe and providing appropriate products across our fund range. Indeed, as a member of the Net Zero Asset Manager Initiative, the NZAMI, LGIM has set an equivalent decarbonisation target to get 70% of eligible AUM into net zero aligned funds by 2030. One point to bring out particularly on this pillar is that our voting and engagement approach on climate issues is brought together particularly within our Climate Impact Pledge, which provides a quantitative assessment of around 1,000 companies with more in-depth engagement undertaken with a number of laggards across a number of industries. So that's our second pillar, how we influence. Our third pillar is how we operate our business. While this pillar has the lowest emissions footprint of the three, it's important that we set decarbonisation targets for our operational footprint for two particular reasons. First, in order to show that we are walking the talk in terms of reducing our own emissions across our offices and business travel, for example, in a consistent manner to influencing other companies within our investment portfolios. And secondly, we are exposed to emissions as a large commercial property landlord and through a selection of our housing businesses, which are also targeted on delivering net zero enabled properties and solutions. So we're quite diverse here, and we bring these pillars together through our governance and our Group Environment Committee, which includes group and divisional board and executive level members, chaired by our Group Climate Change Director. Now, the owners of the businesses where the emissions occur are responsible for delivery of plans to achieve these decarbonisation impacts and targets, and also to take advantage of any commercial opportunities that may arise in this space. Finally, across these pillars, we engage across the industry. As called out before, we are active members of GFANZ, the Glasgow Financial Alliance for Net Zero, through membership of both the Net Zero Asset Owner Alliance, the NZAOA, and the Net Zero Asset Manager Initiative, NZAMI, as well as a host of other leading organisations focusing on progressing the climate change agenda, with many, many more acronyms, which I won't go into now. But one more acronym to mention is that we've committed to the Science-Based Targets Initiative, the SBTI, to develop and publish a set of validated science-based targets early next year. And in fact, we've been working with EcoAct on that in this endeavour. And I think that's probably an appropriate point to pass back to you, Hamish.
That's great. Thank you. I mean, look, I really appreciate, and I'm hugely impressed with the structure that Adrian laid out, because, you know, a lot of the large corporates and also investors come with they have a net zero commitment. And then the challenge is, you know, how do you bring that into a large organization and actually make it happen? And so we're going to go from that level of implementation process and structure to some questions at the higher level around COP27. I'm going to ask a couple of questions, and then I'm going to open it up for Catherine to run the Q&A and just make any comments on the poll results. But the one question I had here was about a key takeaway from the COP27. So because you've all been very engaged in the implementation of your goals, if you had time to watch COP27 news, you know, what is one takeaway, and you know, how do you think what happened in the COP this year will inform what you do in the year ahead? Anything that, you know, that struck you? Maybe we'll start with Hilkka.
Thank you, Hamish, and what a pertinent question to be asking. It's definitely been a mixed bag, good cop, bad cop, confused cop. There's definitely a sense of disappointment, I think, in terms of kind of so there was great progress made at Glasgow last year. There could have been more this year, and in some ways, the kind of watered down language around are we going to progress on phase out of fossil fuels or coal and things like that, and kind of clearly we didn't deliver, or what the COP did not deliver kind of the clear pathway to 1.5. That's a general point. There's some things that I think that can be positive out of it, things like the China and the US still continuing to ring fence climate change in kind of their in their mutual relationship, in terms ring fencing it from political challenges, clear progress on loss and damage. So kind of the recognition that there's going to be damage from climate change, and we're going to have to find a way of supporting those that are most impacted by that, rather than just focusing on mitigation and adaptation. So mixed in terms of what that will mean, or how I foresee that impacting what we do on climate change. There's a couple of things. Part of it really goes back to kind of the thinking about the role of asset owners in this, and the Net Zero Asset Owner Alliance has done excellent work in kind of calling out the role that asset owners can think about this systemically, because we are so exposed to kind of all companies out there. We're exposed to the general economy. We have the perfect opportunity to think about this systemically and holistically, and then also encouraging other actors in the financial services industry and beyond to do so. So for managers, asking them to be thinking about systemic implications of their stewardship and engagement. So things like extending just from individual company engagement, what is BP going to be doing on this specific thing, to thinking about how does this entire sector need to evolve, but also what's the kind of policy environment that is going to be supportive of the best outcomes for our customers. I think I'm expecting to see more discussion, both for us, but also in the general industry, around advocacy and discussions for views of investors in the policy space of what do we need in order to provide safe returns and good outcomes for our customers in the future. So that would probably be one of my key takeaways.
Thanks. Yeah, it's super interesting. I mean, we've been hearing about the levelized cost of energy and the ability of renewable energy to compete on a cost basis with fossil fuels for about a decade now, but clearly there are some policy blockers there to the rollout. And one thing that was announced at the COP was the NGFS, the central bankers did launch some work on blended finance. So in terms of trying to make a bit more predictability possible for large asset allocators into energy infrastructure. But we'll see where that goes this decade. Jamie, did you want to comment on the COP27 and what you maybe took away for your work?
Sure. I think that there was a lot of discussion in it, especially via report released by high-level expert group on this exact topic of our conversations, the reality of the net zero emissions commitments and how to calculate those. I think when we look at this from COP, we tend to think about the state level, the government level pledges, which are also behind, but we also heard from this expert group on non-state entities, and I think it is really critical that we start to build that critical mass of pressure to make these commitments real, both at the national government level, but then also at the non-state actors, these corporations who are very high emitters and really are contributing to the state level target. So it's helpful to see more discussion about how we actually implement these targets that we set several years ago as a world. And I think there is a lot of work to do on that front, but it is useful to kind of at least have folks start to acknowledge that targets are not action, and getting to action is the critical next step at this point. I'm also interested to see the general narrative shifting and around the 1.5 degrees Celsius and how we manage the realities of 8 years being just less than 8 years at this point. So how do we continue to have an ambitious target that is science-based and aligned with that 1.5 target, recognizing that there is a lot of discussion that it might be completely out of reach at this point. But I think still, in my mind, sticking with the original goals is a critical piece, regardless of the realities of how we get there and what we actually land on. I don't want to demotivate us. But that's where I'm at on those ideas.
Thank you. Yeah, I mean, it's fascinating. We have this discussion all the time with operating companies and investors around the pace of change in different jurisdictions. Like if you look at the energy grid composition in the US or Canada or the UK, that really frames what the asset owner is able to rely on and expect in terms of transitioning their portfolio. But I'll circle back to Adrian now for his views on COP27, and then we'll open up for some more questions with Catherine.
Yeah, I just kind of want to pick up that point that Jamie just made, that independent of what happened at COP27, we continue to manage our business towards the ambition of restricting global warming to 1.5 degrees. For us, 1.5 is alive, and we will do everything we can to keep that going. I think it points to and gives extra emphasis to the fact that we will not be able to deliver on this ambition unless the political and global economy support and will and policies are there. But we will continue to do as much as we can, finding the right investment opportunities, influencing both our investee companies, but also influencing public policy to make these tough decisions. And ensuring we're investing within the economy through the property and infrastructure portfolio, again, working with policymakers in that regard. So we continue to influence where we can and push that forward, independent of what's been agreed at this point. I mean, other consideration, I suppose, is transitioning away from fossil fuels globally while maintaining energy security across the globe is a really tough ask. If it was easy, we'd all have done it already. It is a really tough ask, and we will continue to engage with those bodies to work through the most orderly and just transition available. But it is a necessary step to keeping the dream alive, certainly in my opinion.
Good. I mean, thank you. Keeping the dream alive is a nice message. And I think, I mean, the people I've spoken with, and we, Catherine and I, speak to people across different continents. I mean, there's certainly a lot of ambition and, large companies that are committed and going for it. So, it is, let's see what happens in the next year. Catherine, did you want to follow up with some questions?
Sure. Thanks, Hamish. So I think we shared the poll results just after we closed the poll, but I will share them now because I think we've had some really interesting results. So the first one we asked, have you set a net zero target? And striking to me was the fact that nearly a quarter of participants haven't set a net zero target and are not intending to in the coming year. So I think kind of Adrian with two hats on, both with LNG kind of in the process of setting their own target, but also as an owner trying to engage with other companies on their progress. What are the implications of this when companies haven't set a target, and what can you do about it?
Yeah, I think as I said, the engagement through our stewardship team, it's a continuing and evolving process. That stewardship team have operated for a number of years on a number of issues, and a lot of these issues are long-term issues. I have to say I'm slightly surprised at those poll results, and it kind of gives us extra emphasis to re-engage with that emphasis, to make sure there is widely understood needs, as we've talked about so far in this agenda, around why it is important for individual non-state actors to engage in this journey. I think just maybe from our own experience, we are a long-term company. Hilkka called out the long-term, similarly for Aegon, we are long-term businesses here, and we have long-term liability. So we have to look to the long-term risks, and this is a key long-term risk. So I think it's just a matter of keeping that engagement going, and re-highlighting the consequences of not acting, to ensure that we do support an orderly transition as possible, as I just laid out too.
Thank you. I think kind of if you see what's coming out from the Science Based Targets Initiative, then it seems like lots of companies have committed to setting a target. So hopefully we'll see this improve in the coming year or two. So just looking at the second question in the poll, what do you need to make your climate commitments actionable and achievable? So a little bit more mixed here. I was definitely curious to see that additional human resources was actually lower on this list. We've had an audience member allude to those couple of GFANZ members that have cited this lack of resourcing as a reason for quitting that. But I think I'm just curious to hear from Jamie. I feel like kind of a lot of what we've talked about already. I mean, greater action from leadership. We've already seen that with the kind of letter from the Comptroller to BlackRock, and we've talked about public policy alignment. But I was just wondering if you had kind of any more success stories that you've seen in the work that you're doing that have contributed to making the commitments more actionable.
Yeah, I mean, I don't want to underemphasize what is by far, in my opinion and our opinion, the most important component, which is really asset manager engagement and alignment here. But I will say that on the positive side, it is very helpful that especially our leadership, Comptroller Lander has set a goal to evaluate climate risk across the portfolio of activities that we undertake as the Comptroller's office. And then it is a holistic approach that we look at from top to bottom. And I think the question related to human resources becomes less of a challenge when we start to think of managing climate risk and achieving net zero as part of everyone's job rather than just folks that are climate specialists. And I think that will solve for a lot of the challenges that we're seeing, because it is very much touching on everything and is a critical issue regardless of where you sit in an organization. And so starting to really train up everyone rather than just climate experts is something that we can work towards, and something that has been very helpful in our case, that we have implemented this as a priority across the board throughout the entire organization.
Yeah, that's great. I think we're seeing kind of where the, as you say, where the kind of leadership takes place is where these decisions aren't being siloed into those separate sustainability teams, but really integrated across the whole business. And it's kind of a sneaky question, really, because I think they're all really important levers to push on in driving climate action. So then the third question about how do we increase allocations to climate positive companies and projects. Again, we've had a similar range of answers, but I think Hilkka, as you kind of mentioned, you know that for Aegon we work almost entirely with third-party asset managers who have a lot of kind of control over these more climate-focused products and services. Is this a challenge that you're seeing? Because I know you mentioned kind of 90% of your investors don't adjust their pension allocations. So kind of, do you have options there to offer them?
It's such an interesting question because it kind of touches upon what is a climate friendly investment. So there's a broader question of, you know, what is the role of investors? What can we do? And clearly there's a lot of things that we can do, but we have kind of one part of the puzzle in terms of kind of channeling finance and kind of managing the risk and keeping the dream alive, as Adrian had. But I love that phrase. I will definitely be using that. We need a bit of dream alive keeping at this point. So there's two things. One is, how do we make it easier for customers to access? And then the other thing is, what do we drive in where the customer doesn't make the choice? Now, if you certainly in the UK pensions market, a lot of this is actually just accessing the broader stock market. So within that, when you look at kind of, you're exposed to typically a vast majority of companies, because the kind of vehicles that you typically invest in or will have at least some part of your portfolio in. That point I made earlier about kind of not just selecting the companies that are responsible and sustainable, but thinking about the entire kind of pool of companies that are in the listed market, I think becomes critical, because investments can only be really as sustainable as the companies are. So our starting point has always been, we need more sustainable companies, which is then a slightly different thing from kind of us saying we're going to pick this subset that are particularly sustainable. And that's where the point about engagement, both Jamie and Adrian also mentioned this point about engagement, engaging the managers, and then asking the managers to be very specific when they are talking to companies or voting their proxies at AGMs. What are they looking for? Have they communicated what's the direction of travel that they want to see? To Adrian's point, I was also quite surprised by the kind of audience results in terms of who has set a net zero commitment, because our ask would probably be, yes, please do set a net zero commitment, and work with us as investors or across your different stakeholders to support you in that. And what does it take? So there's kind of one element of it. In terms of like availability of products that invest in so-called sustainable companies, you may have more choice if you go outside of the listed space, but then it's I suppose you typically get less transparency. We know that a lot of the highly emitting activities in the global economy also happen outside of the stock market. It's not institutional investors like us, all of us on the call, who are invested in them. You move a lot more into kind of private markets kind of space, state-owned enterprises, etc. So you have kind of you might be able to invest into renewable energy projects that you wouldn't typically access directly in the listed market, but then you'll also have everything else. There's a lot more focus on kind of the investor putting scrutiny on those. It is kind of accessing that, particularly in that kind of the UK pension space, can be tricky. Most of the kind of institutional investors, and if you're in pensions in the UK, like listed is considered safer, longer track record. There's kind of more knowledge and experience of that. And if you move outside of that, there are some hurdles to go through, including the fact that if you are say putting up solar panels somewhere, typically people will expect you to commit your capital for a much longer time. You're taking on more risk. So for some institutional investors, it's a lot more challenging. I am hopeful that we're seeing a lot more progress in terms of what kinds of investment products are made available around that. So kind of trying to square that circle. I think we could have more product innovation from asset managers on this, so we don't kind of get the same sort of suite of sustainable companies in different kinds of wrappers, because those kind of products are already widely available. So it's kind of trying to, on one end, satisfy different types of customers with different types of kind of knowledge and risk kind of appetite on one hand, and cost considerations, and then the other hand trying to match the companies and how sustainable they are. It's quite the mix.
You kind of want to establish a positive feedback loop of customer demand and product creation between the investors and the asset managers, don't you? Interesting. So thank you for all those questions on the poll. I think we've had a couple of really great questions through in the Q&A. One of them touches on a key point I found really interesting, is thinking about asset manager engagement, and really, as I think Jamie and Hilkka both kind of referred to, is asking for that transparency from asset managers. And someone has said that they are asking their pension scheme about where they have exposure to the fossil economy, and really struggling to get access to it, saying that either they don't have that data visibility or kind of similar challenges. And I'm just wondering, kind of, what have you had any successes, and what challenges are you seeing when asking asset managers for that transparency?
Sure. When our trustees voted, the three funds voted to divest, they retained independent investment consultants who conducted analyses across the portfolios to identify the risks posed by fossil fuels companies, and then the nature of how divestment should proceed from that perspective. So it was set upon a target of 5 years and achieved within those 5 years. of course, it's challenging, but in a lot of ways, it is kind of a critical step for our trustees. They were committed to it, and it's something that they were willing to kind of take the time and engage the right experts in doing. And for what it's worth, our funds, all of our funds are passively managed or externally managed, and there was collaboration with our asset managers on how to achieve this goal that were set by our trustees. This was a critical piece of this. And we feel and are fairly confident that the long-term risk mitigation that divestment created will in fact bear benefits. And obviously we've seen a very volatile market this year, and there's always going to be some challenges in that market. And it is clear that this is in line with our goals and manages the risks that we have as fiduciaries, and we feel confident with that, and specifically related to stranded assets and the changing industry and how things will progress over the next several years. So it is not a easy activity, but it was achievable through the engagement of both asset managers and independent consultants, some of which were overlapping.
Yeah, sounds like a big undertaking, but a kind of fruitful outcome. I'm just curious, kind of building on that, to hear from both Adrian and Hilkka, kind of where divestment isn't possible. There is, in the UK, there is a very kind of new focus on transition plans. I'm just wondering, has this kind of come onto your agendas, and how do you see this evolving in the next few years? Because I think even if you're not divesting, kind of the transition plan for the fossil fuel economy is going to be a big one for investors.
I'm happy to take this first, if that's all right. Just to conclude the point around engagement, we certainly don't see engagement as the only lever. It has to be engagement with consequences. So within our stewardship team, and I mentioned our climate impact pledge within the introduction, there are some guidance as quantitative assessment of a number of companies, but also some guidance around where we do see some red lines and what particular activities will encourage us as an asset manager, LGIM as an asset manager, to vote against companies. And then me on our asset owner hat on, we can look at that information, and we can decide in areas where it's clear cut or the engagement is not working, we can decide to exclude or divest if necessary. It's not off the table. It's just, I think, just want to clarify that focus very much is engagement as the focus, but not, it is engagement with consequences. That's the important part. But building on to that, yes, transition plans, that's something that we're looking very strongly at, and to support the indeed the UK's transition plan task force have developed some guidance. GFANZ have developed some guidance around transition plans for the financial services as well. We agree that is a great step forward. First step is to set targets and to set out your ambition. Then you have to understand how you will achieve that ambition, and disclosing the transparency around that through a transition plan is a great tool in our opinion.
Great, thank you, Adrian. Hilkka, go on.
Yeah, what I would probably just add to that, because I could do agree with all the points made on this beforehand. The point about divestment versus engagement is an age-old debate, and there are investors who've said we're going to divest from fossil fuels because that's not compatible with a long-term low-carbon future, and therefore we're protecting ourselves from stranded asset risk and transition risk, as Jamie already mentioned. The view that the alternative view to that is obviously that just because you're not invested in them, they do not go away. And there is an increasing concern that particularly if all listed market investors, all institutional investors do divest, then what happens to those assets? And do they get taken on by owners who perhaps care a little bit less about climate consequences? So it is not, I guess what I'm calling out that it's not a simple equation. I think Adrian's point about kind of engagement with consequences and a clear escalation strategy is the direction that we're also going in. So we've got that for the asset managers that we work with. We give them asks, and we give them a time frame to work towards those asks, and then we have an escalation pathway that ultimately there is the risk, that we might we might remove them from our funds. It might be look, we're just not aligned anymore. But that's not, I don't think that can be the first step. And obviously for us as clients, the asset manager, the relationship is slightly different compared to us being an investor in a company, because you can still remain at the table, and just as you say, like, employ different levers, vote against management, collaborate with other investors in terms of engagement. So to the person in the audience who asked, is it possible to divest? Yes, it is. The other questions, is it always desirable for the outcome that you are seeking? And on that, the answer is quite nuanced.
Thank you. I'm curious now, this will probably just be our last question. I know we're coming up to the hour mark, but something we haven't talked about is kind of strategic asset allocation. How do you see this changing in the coming few years? And do you have scope to kind of be investing in some of those more targeted climate positive investments? Because I think we've been talking about the kind of like the laggards and the higher emitting companies and sectors, but kind of more on the positive end. Are there any success stories that you'd like to share there?
Sure, I'm happy to jump in there. We are, because of some legal changes in New York State, and just generally, there is likely going to be a review of our asset allocation in the coming year or two. But beyond that, we do have this large commitment to climate solutions across all three systems. And what we found in the last few years is that very much it's not necessarily addressing real economy needs. And I think Hilkka was alluding to this to some extent, that there is, investments in every sectors that could be considered climate solutions, but we're not necessarily being opportunistic about it or contributing to critical needs in the country or in the world, from a technology perspective or a deployment perspective. So in the coming years, we are really looking at how to manage that approach of being, again, asset owners that are dependent on our managers, but really being more opportunistic about our climate solutions and thinking through that strategically. And I think there's a lot of opportunities in the coming years, especially as we look at asset allocations and legal changes and things like that.
Yeah, thanks, Jamie. And I think certainly in the UK, we're seeing more of this with kind of the supportive regulatory environment now for pension funds. But we're nearly at time, so I'm just want to kind of thank the speakers for their participation in the Q&A session, and I'll hand back to Hamish to wrap up.
That's great. Yeah, I would just second the thanks to all the audience, everyone for showing up, and also for the speakers for joining us. And of course, I'm going to ask my favorite question in a webinar is, what is the lesson? What is the key takeaway for the audience? So if you want them to leave with one point based on your work to date, what is that? Because everybody has a lot of work to do this year. So on this net zero front. So what is your one takeaway point? And we'll start with Adrian and then Hilkka.
Absolutely. Happy to go first and refer back to your survey response. And it's a bit of a plea, but please just get started. Get started on the work. Get access to some data. It won't be perfect. There'll be proxies. There'll be assumptions in there. But this is, the way this is a long-term threat to our civilization, and therefore, just getting started, it won't be a perfect response, but at least some kind of thinking and escalating that up within your organization, I think would add to the long-term risk mitigation within your organization. So more of a plea rather than an action point, I suppose.
Final plea, Hilkka.
I was actually going to go after the exact same plea. Don't wait for the data to be perfect. It won't be, and you'll be surprised by how much you can do even if you don't have all the data. Consider what you can influence, where your risks are, like what does it actually mean for your business? And if you understand that, then I can guarantee you, you will be taking action. Understanding that, the risk as well as the opportunity. There's a huge amount of resources available from, you don't need to do this alone. There's so much out there. Lots of people who are trying to make this work and make this transition a reality, keep the dream alive. Go out for it, look for it, and yeah, get started. Kind of the same as Adrian, really.
Thanks. Jamie?
Sure. I'll just round it out by saying I encourage everyone to think about this from a holistic nature and from A to Z in your organization and among your colleagues, so that we can really see a large scale change, because we're implementing this at all levels.
Thank you. Wonderful note to end on. A to Z. Structural change requires big thinking and a whole lot of work, but there's no time like the present to get started. And I think that's a nice plan for the year ahead, is to actually do something. So there's progress to assess at the next COP, at COP28. So again, I'd just like to thank everyone, speakers, the audience, and also if you have any questions for any of the speakers, get in touch, or if you have questions for Catherine and myself, please get in touch. And it's been a real pleasure, and we look forward to progressing the climate change front with all of you in the year ahead.